The Federal Reserve Bank just changed their stance on inflation and interest rate cuts, and we just got new data saying that inflation is cooling down faster than we expected. So let me break down what happened, because yesterday was a pretty big day when it came to financial news. We don't usually hear the Federal Reserve Bank and inflation data come out on the exact same day. So let me break it all down. Starting with the Federal Reserve Bank, Jerome Powell, who's the chairman of the Federal Reserve Bank, said for the first time since the pandemic started that there has been modest further progress when it came to inflation. What is modest progress? Well, let's compare that to what Jerome Powell has been saying previously for the last couple of years, which is that they're waiting to see further progress with inflation, that there still is more progress to be done. For the first time, yesterday, he says that we have begun to see this modest progress with inflation. What does that mean? That inflation is starting to cool down. Now, as a reminder, inflation cooling does not mean that the prices of things are falling. It means that the prices of things are rising less quickly than they were before. How is the Federal Reserve Bank working to cool down inflation? Well, they're doing two things. Number one is that they have raised interest rates significantly. And number two is they're doing something called quantitative tightening. Quantitative tightening is, in the technical term, they are reducing the size of the balance sheet. What does that mean? Well, in 2020, 2021, the government, United States government, was spending trillions of dollars it didn't have. Where were they spending this money? Stimulus checks, unemployment checks, PPP loans, grants for businesses. The government spent trillions of dollars it didn't have, and in order to spend this money, the government had to borrow this money. Who did they borrow this money from? Well, one place was the Federal Reserve Bank. Now, while they're called the Federal Reserve Bank, they're not federal. It says so on the website. They're not a reserve because they don't keep cash reserves, and they're not a bank because you and I can't go there to deposit money. But what they have the ability to do is print money and lend it to the government. So the government spent trillions of dollars, but they needed that money from somewhere. The Federal Reserve Bank print and created this trillions of dollars out of thin air, and then they lent this money to the United States government. This then built up what's called the Federal Reserve Bank balance sheet. The Federal Reserve Bank had all these loans that they issued to the United States government, which were sitting on their books. But now, to reduce inflation, they're trying to get rid of this huge balance sheet. They're trying to sell off these loans, and that's what they've slowly been doing as a way to stop having all this free money out there. Now, it's a gradual process, but that's one of the things that they've been doing. The second thing that they've been doing, which is a little bit more visual, is they've raised interest rates significantly. That's why when you go out to buy a mortgage today, you buy a home with a mortgage, it's going to cost you a whole lot more in interest than it would have 3 years ago. Same with your car, same with your credit card. And this is where what a lot of people were hoping for was some insight onto when the Federal Reserve Bank would start cutting interest rates. Why? Because you have a lot of institutions on Wall Street that are hoping that the Federal Reserve Bank will start cutting interest rates to stimulate the economy, to boost the economy. Now, if you've been keeping up with the financial news, you've been reading market briefs, you know that the economy is kind of in a weird place, because on one hand, we still have what's reported at a 4% unemployment number. That's historically some of the lowest unemployment that we have ever seen. We have companies that are still seeing these record revenues and record profits. So what do we need to stimulate exactly? Well, if you're an investor, you always want to see your investments go up in value. And this is where there's been a lot of pressure and political pressure put on to the Federal Reserve Bank to continue raising, or rather in this case, cutting interest rates. Because when you cut interest rates, it stimulates spending. When you cut interest rates, more people can borrow money. That boosts the economy. It comes with a consequence, which is inflation, but well, who cares about inflation, right? Well, that's what some of these people are saying, which is screw inflation, keep boosting the economy because it's going to keep boosting our asset values. And this is where a lot of traders and institutions have their eyes glued on the Federal Reserve Bank, hoping for interest rates cuts soon. And this is where what Jerome Powell said yesterday, gave some insight on this, which is essentially that the Federal Reserve Bank is going to continue not cutting interest rates yet. And they might not cut interest rates as many times as you thought in 2024. Initially, people thought maybe the Federal Reserve Bank would cut interest rates 6 times in 2024. Then people thought maybe they'll cut it 4 times in 2024. Then people thought maybe they'll cut it 3 times in 2024. Now, what Jerome Powell is saying is maybe we'll cut it 1 time, maybe 2 times in 2024, but probably closer to the 1 time. So a big change in thought when it comes to interest rate cuts. So for you people that are wondering, when is the Federal Reserve Bank going to cut interest rates? We don't know, but he gave us some insight on that. By the way, if you want to stay up to date on what Jerome Powell and the Federal Reserve Bank is doing, Market Briefs is a free resource that we created. It's a free newsletter that breaks down what's happening in the financial markets. You can read it in less than 5 minutes every morning. It's completely free. I got the link for you if you'd like to join down in the description below. But what Jerome Powell did say, which was interesting, is that they are anticipating ramping up interest rate cuts in 2025. Right now, what was projected was 3 interest rate cuts in 2025. Now he says it might be closer to 4 interest rate cuts in 2025. It's kind of like that transitory inflation that is just a temporary thing. We kind of just keep talking about what's going to happen in the future, get you excited about the future, but we'll really adjust what happens when it comes to that time. Kind of like how they said that we'd see 6 interest rate cuts in 2024. So just take everything you hear from the Federal Reserve Bank, the government, and even a random guy on YouTube with a grain of salt. This brings me to the topic of inflation, because we also just got some new inflation data, which says that inflation came in lower than expected. What does that mean? What was reported was CPI at 3.3% versus the expectation was 3.4%. That means inflation was expected to come in at 3.4% over the last year. It actually came in at 3.3%, which is lower than expectations, which is why a lot of people got excited. The reason why a lot of people got excited goes back to the Federal Reserve Bank, because if inflation is coming in cooler than expected, it comes closer to the Federal Reserve Bank's target of 2% inflation. Remember, not 0% inflation, not negative inflation. The Fed wants 2% inflation. Then the Fed might be more enticed to cut interest rates and stimulate the economy. And so that's why a lot of people got excited with this inflation report. But what's interesting is if we dive in a little bit deeper to where the inflation is and isn't, you might see why some people are feeling more inflation than others. The top 2 places where inflation was the highest was car insurance and shelter costs. Actually, if you look at the top 3 places, it was housing costs for number 2 and 3, because if you look at rentals and house ownership separately, you'll see that it's car insurance, housing, and housing, top 3. But if you look at the bottom places where inflation is the lowest, where it's negative inflation, where the price of things are falling to lower the overall inflation number, where inflation has come down the most, number 1, rental car prices. Number 2, toy prices. And number 3 is used vehicles. So if you're not going out and renting cars, and if you're not going out and buying toys, well then that lower 2 and the top 2 kind of skew, because everybody needs car insurance. If you drive a car, you have to have car insurance. Everybody needs shelter. So it's one of those things where the people that are paying the price, with higher grocery costs, higher housing costs, higher car insurance costs, the overall inflation number is getting balanced out by a lot of things that people might not need day to day, like rental car prices or toys. But number 3, lowest, is actually used vehicles, which is nice for those of you that are thinking about buying a used car. So what does all this mean? Well, there's a couple things I want you to pay attention to. First is you don't want to get caught up in the emotions, because anytime the Federal Reserve Bank speaks, anytime you get a new inflation report, you see the market do one of 2 things. It can boom or it can fall. And it's because people get very emotional about the headlines. But no real money is made that way. The real money is made when it comes to trends, when it comes to really understanding where markets are moving. And so the first thing as a financially educated person is to cut through the noise when it comes to emotion and really pay attention to the financial trends of what's happening in the broader markets and the different things that can affect the economy. For example, interest rates affect many different parts of the economy. It doesn't just affect how much money you're going to have to pay to buy a home. Some of the bigger places that it's going to affect are corporations and commercial landlords. And the reason why is because they don't get 30-year fixed rate mortgages. And you have a lot of institutional investors. You have a lot of big corporations. You have a lot of big commercial landlords that are sitting on millions, if not billions of dollars of debt, that are now going to start readjusting 2024, later this year, 2025, and 2026. And the reason why these people have their eyes glued on what the Federal Reserve Bank is saying is because if interest rates readjust for them, that means they're going to go from a 2% loan on billions of dollars to a 7% loan. That's a big difference when it comes to your monthly payment. And so for these people, it is very, very, very important what's happening with interest rates and inflation, because that can really dictate how that's going to impact their bottom line. These higher interest rates are having an impact on the economy. Now, we could take a look at the jobs numbers. A lot of people feel like the job market is not working for them. Well, it is working for some people, but a lot of people feel like they're underemployed. I made a video on this recently where about half of college grads are working high school level jobs. It's actually more than half of college grads working high school level jobs 1 year out of college, but 10 years out of college, 45% of college grads are still working high school level jobs. So some people feel like the job market is not working for them. This is where, again, it is so important for you to understand what's happening, because there are some things that you can control, some things that you can't control. One of the things that you can control is what you do with your money. And the reason why what you do with your money is so important is because it's going to either set you up for opportunity or set you up for utter failure when things go wrong. And notice how I say when things go wrong, because the reality is things will go wrong. If you look at the history of our stock market, you look at the history of our economy, we know that our economy goes through booms and busts. Every decade, the United States economy goes through a recession. Every decade, we see a downturn in asset prices. It has happened in the past, it will happen in the future. The problem everybody has, or a lot of people have, I should say, is they try to time when it's going to happen. They time when we're going to see a downturn in the markets. They time when we're going to see a stock market crash. But if you're timing the markets, you're going to end up losing money. It is next to impossible to do that. But what you can do is be prepared for when a downturn happens. Now, this doesn't mean you don't have to invest your money until you see a downturn, but what this means is you want to make sure you have a financial system that allows you to win when markets are up and when markets are down. But in order for you to win when markets are down, you have to be prepared. That means, number one, you have to have cash to protect you in case you lose your job, in case of an emergency. And number two is you have to have cash to be able to go out and capitalize on investment opportunities. Because you can have all the financial education in the world, and you can identify a great investment opportunity. But if you have no money, you can't do anything about it. And this is where you want to start preparing when times are okay, instead of trying to prepare when times are not okay. Because what ends up happening to a lot of people, and I've seen this now because I was making videos through 2020. That was my first time creating content during an economic downturn. When I was talking about buying stocks on the stock market when it was crashing, I had two types of comments. Number one was people were saying, why would you buy? The economy is going to collapse, which is always a emotion when you see a downturn. That's nothing new. But number two was, how am I supposed to go out and buy stocks when I don't have any money before the stimulus checks went out? And the thing is, people always start caring when it's a little too late. Because obviously, when something tragic happens, you start to realize, oh, maybe I should take care of my health. Oh, maybe I should have taken better care of my money. But the key is really preparing when times are okay. It's better to take care of your health before you have a heart attack. It's better to take care of your money before you have a recession. And this is where that financial education, mixed with being prepared financially, mixed with understanding the trends, is really the trifecta to being able to build wealth long-term in an economy where you have booms and busts. But that requires you to start investing in these things when things are okay. So, the Federal Reserve Bank says no interest rate cuts right now. Maybe we'll see another interest rate cut later this year. Inflation is coming down a little bit cooler than expected. If you want to stay up to date on things when they're happening, make sure to join Market Briefs. And if you enjoy videos like this, hit that thumbs up button and please subscribe to this channel as well.